Hi viewers, Namaste. In this video, we will find out what is an income statement, what are the basic important elements to observe in an income statement, what should we infer from an income statement, and how should we use it for making investment decisions. So, let's start our video. Welcome to the world of Gettrading. First things first, what is an income statement? To explain it in simple terms, an income statement is one of the financial statements of a company that clarifies the different revenues and expenses of a company for a particular period, also showing its profits or losses at different levels. The period could be monthly, quarterly, or annually. Next, what to observe in an income statement? Well, traditionally, these are the components we need to observe in a financial statement. But the thing is, formats of financial statements keep changing based on changes in Indian accounting standards. So, instead of explaining about the theoretical knowledge, we thought of sticking to our main objective of our video. That is, by explaining a recently released income statement itself. Source of the statement? We can get an income statement from the company's annual report, but it is too complex to understand. So, we suggest you to download financial statements from moneycontrol.com, which will give us refined income statements. Now, regarding which company to take as an example, upon researching multiple companies' income statements and after several discussions, our team has chosen Interglobe Aviation Limited, shortly called Indigo. Reasons: 1. It is one of the leading companies in the aviation sector. 2. It has good growth rate. 3. It is one of the multi-baggers suggested by many analysts which gave decent returns to investors. Before going in depth, let us clarify one thing. As this is just a basic video to understand about income statement, there will be many advanced topics unsaid and unattended. But we promise you that you will surely get basic knowledge about how to read an income statement. From there, you can practice well and can improve your expertise. If you face any problems during practicing, you can contact us on our Telegram group or can email us to the below mentioned email ID. Okay, this is the raw income statement which you get directly from Money Control. For presentation purpose, we have made few format changes and also shown these years in ascending orders. This arrangement in ascending order will make your analysis easy. Okay, this is the yearly statement of Indigo, that is for 12 months. So, if it is a 2019 statement, then it is the data from 1st April 2018 to 31st March 2019. So, let's start studying income statement step by step. First, revenues, which can be also called as sales. Revenue from operations means revenues company has generated from its core daily businesses. See, here in the year 2019, the revenue is Rs 28,165 crores. Now that we know the revenues, what will we do from it? We don't know whether it is more or less. For this, an income statement should be inferred by comparing it with previous years. Ideally, we call this finding growth rate. You know how to find growth rate, right? This year's revenue minus previous year's revenue divided by previous year's revenue and multiply the result with 100 to get in terms of percentage. This is called horizontal analysis. One more important thing analysts check in revenues is that how much of the sector's market share is this company capturing. So, in an year, if there are less profits but revenues increased and captured maximum market share, with some other confirmations, analysts may feel that the future of this company will be good and so take their investment decisions in that company. Anyways, in the same manner, you can find the growth rate of Indigo over last 5 years as shown here. We would be happy if the company is maintaining at least 15% growth rate annually, which in this case is above it. Now, another important application of financial statements is forecasting. Analysts forecast future volumes from past results and then take their decisions on investments. There are many types of analysis which focuses on qualitative and quantitative fundamental analysis. Since this is quantitative analysis, we are considering only number factors, keeping all other factors as constant. Out of many techniques, we will use simple averaging method to forecast. Moving on, we need to take average growth of revenues of past 5 years. In this case, the average growth rate is 19%. So now we are assuming that next 5 years revenue growth will be 19% year on year. With this input, we will forecast the revenues of the next 5 years. How? By using this formula. Next year revenue is equals to this year revenues into 1 plus growth rate. So, we have forecasted that 2020's revenue will be rupees 33,516 crores and so on. As said, this is only one type of analysis. We just took this for example and no official conclusions can be made in this video. This is just for basic understanding of forecasting. Okay, before moving on to expenses, important things to remember in revenues. Operating revenue should be separated from non-operating revenues that occurs from infrequent, unusual or one-time events. And the same goes with other incomes too. If at any time you want to know the breakup of these incomes, you can go to the annual report and search in it. Professional analysts spend days and days on every company and analyze even minute details while forecasting. Okay, next, expenses. Expenses plays vital role in projections and valuation of the company. We should figure out what the major expenses are for a company and check how much it constitutes, that is, percentage on revenues. Tracking these expenses can also help us to know how efficiently a company is using its resources. Looking at Indigo income statement, following are the expenses which are summing up to major expenses. 1. Aircraft fuel expenses. Rupees 11,942 crores. You know how to find its share in the revenue, right? Yes. Particular expense divided by revenue into 100 for percentage. Next, aircraft lease rentals. Other expenses. Employee benefit expenses. This is called vertical analysis. These expenses can also be projected for the next 5 years, taking average contribution on revenues of past data. Expenses tend to have a stable relation with revenues, so these items tend to be forecasted as percentage of revenue. Remember again, since this is quantitative analysis, we are taking the average growth rates considering all other factors constant. These factors could be market factors like GDP, unemployment, fuel growth rate, interest rates, etc. So, by finding out the average expenses for every element, we will forecast next year's expenses with same percentage of revenue as we forecasted before. One more advantage of doing this analysis is since we are considering major expenses, for example, aircraft fuel expenses in this case, in future when you are actively trading in the markets and you heard that fuel expenses are dropping or surging, then you can take a call on Indigo stock because you know that more than 50% of the revenue is going to the fuel expenses. So, any increase or decrease in the fuel expenses may affect the company's net profit and thus EPS. The same applies for any expense of any company. Moving on, during projections, this finance, depreciation and amortization costs should be taken constant as this will not often change. So, we took same 2% each on the revenue. Just in case if you are interested, finance costs or borrowing costs are simply interest and other costs that a company incurs in connection with borrowing of funds, like loans, etc. This includes coupon payments on bonds and debentures too. So, abrupt increase in finance costs should be justified well, whether they are being utilized properly or not. We can check them in annual report too. To understand about depreciation, for example, if a company procures some 10 crores worth machinery and think that its useful lifespan is 10 years, then per year depreciation cost will be 10 crores divided by 10 years, that is 1 crore per year. The same will be reflected in income statement. So, all tangible assets, that is, those assets which are physical, comes under depreciation. The same case with amortization too. If a company got a patent for 5 crores for the life period of 10 years, so 5 divided by 10, 50 lakhs is adjusted under amortization. So, intangible assets, that is, those expenses which are not physical, for example, patents, franchise agreements, etc., these expenses are spread over amortization. By to by, if we subtract the revenues from expenses, except these two costs, we will be getting operating profits, what everyone calls as EBITDA. That is, earnings before interest, taxes, depreciation and amortization. This can also be called as PBITDA, profits before interest, taxes, depreciation and amortization. EBITDA allows analysts to focus on the outcome of operating decisions while excluding the impacts of non-operating decisions like interest expenses, tax rates, or large non-cash items like depreciation and amortization. Next thing, if we take away the depreciation and amortization from what we saw EBITDA, we will be getting EBIT. For some companies which has least depreciation and amortization, this EBIT or PBIT can also be called as operating income or operating profit. These operating profits are a great tool to analyze companies' operating efficiency. Generally, analysts calculate the operating profit margin, that is, operating profit to revenues, and use it to compare companies in the same sector. Next, this is PBT, profit before taxes. PBT exists because tax expense is constantly changing, and analyzing profits before taxes help us to get good idea of changes in companies' profits or earnings year on year. Next, taxes. We don't discuss about taxes as of now as it is a lengthy subject. But remember, any decrease in taxes will increase the net profits of the company and thus EPS, which sentimentally increases the price of a share. You can recall why few shares rallied when government announced corporate rate cut. When forecasting, we take tax as 25% on PBT in this case. Next, we need to observe the important element, net profits. Net profits are the final profits in which a company gets. We can observe the growth rate of net profits year on year as done for revenue. Also, we can calculate the net profit margin. If you recall vertical analysis, this net profit margin is net profit divided by revenues in terms of percentage. A higher net profit margin means that a company is more efficient at converting sales into actual profit. Less margin shows the inefficiency of a company to convert sales into actual profits. Next, EPS, earnings per share. This is the result of net profit divided by total outstanding shares of a company. This is one of the most important variables in determining a share's price. Investors tend to invest in the stock which has good EPS and growing EPS too. In this case, the combined EPS is approx 470 for the next 5 years. So, whatever may be the price of a share now, with this forecast, investors feel that the share price may increase by 470 rupees for the next 5 years. Again, this is just an example. Income statement alone cannot define a share price. There are many other analyses too, which we will learn step by step in this playlist. This EPS is an important element to find out PE ratio. These ratios, including EPS, will be explained in some other video which will be made specifically for these. So, this is the basic method of how to read an income statement. Let's meet in the next video, how to read an balance sheet.